Tina Mitchell here with your Money Chat. Existing home sales, which measures closings on existing homes, showed that the sales were down 2.7% in March and at a 5.77 million annualized pace. This likely measured activity in January and February, including some of the move higher in rates, but not all of it. On a year-over-year basis, sales are down 4.5%, which is still quite strong considering higher rates, higher home price, and tight inventory. And speaking of inventory, it did increase almost 12% from February to 950,000 homes for sale, which is down about 10% from last year. This is the normal inventory build that occurs every year at this time. There is now 2 months supply of homes, up from 1.75 months, when a 6-month is considered a balanced market. Now, speaking to the imbalance of supply and demand, homes were only on the market for 17 days in March, down from 18 days. 87% of homes that sold were on the market for less than 1 month. Now, these are national numbers, not our local market, which is a lot more extreme. Freddie Mac reported that the U.S. is 3.8 million homes short of the demand that existing homes in the country for single-family homes. While demand is less than 2021 due to the higher interest rates, it's still robust. Now, the imbalance in supply and demand should continue to support our home prices. First-time homebuyers have accounted for 30% of sales, which is a nice move higher from 29% in the previous report and 27% 2 months ago. Cash buyers increased from 25% to 28%, while investors purchased 18% of homes, down from 19%. Foreclosures and short sales account for less than 1% of all transactions. CoreLogic released their loan performance insights report showing that loans 30-day or more past due decreased from 3.4% to 3.3%. Those that are seriously delinquent more than 90 days decreased from 1.9% to 1.8%. Homes that are in foreclosures remain at a multi-decade low of 0.2%. On the Fed front, the St. Louis Fed President James Bullard spoke and talked about the possible 75 basis point hike. He wants to see that the Fed's fund rate get to 3.5% by the end of the year, which would mean 50 basis point hike at the upcoming meeting this year. Inflation is a big problem and the Feds know it. Listening to Fed speaker, many are saying that they believe that we can achieve a soft landing, meaning that they can tighten while not causing a recession. Charlie Evans and Blackstone CEO mentioned the issue of wage price spiral. That means that if inflation goes up, goods cost more and people demand more wages, but then those that are higher wages cause more dollars chasing fewer products and cause more inflation. The spiral can be problematic, especially with the supply chain issues that appear to need much more time to sort out. Now, there is also a story regarding jet fuel shortages in the Northeast, which is also will impact summer travel, which will cause even a higher inflation. Everyone is talking about a recession, especially as the Fed hikes rates, likely 50 basis points at the next meeting. Does the Fed know that that this is a little bit crazy and that we're heading towards a recession? The only thing that the Fed can do to curb this rapidly rising inflation is to destroy the demand side of the economy. And while the Fed would never admit this, I think their plan may be to cause a recession because it is the only thing that will effectively reduce inflation. The last time the Fed hiked 50 basis points, which was in 2000, we saw a recession in less than a year. Now, I believe we're heading for a recession and the Fed knows it as well. While recessions are not good for the overall economy, interest rates will come down significantly and real estate performs well. I have heard media outlets say that a 50 basis points hike is already priced into the market, but is it really? Maybe in the stock market, there's been some price already in that, but in the general market has not. If you borrow money as an individual or a company, and it's based on a certain amount basis points over secured overnight financing rate, SOFR, it will have an enormous difference in the borrowing costs. This may cause the planning on borrowers to rethink and slow down expansion, especially companies borrowing large sums of money. I will continue to keep you up to date on inflation and our most likely recession around the corner. Tina Mitchell, and that is your Money Chat.